Hello, ladies and gentlemen, Greg Mikulowski with a Forex look at the three commodity currencies, the dollar versus Canada, the Aussie versus US dollar, and the New Zealand versus US dollar. I'm going to take a technical look at these currency pairs. What has the US CPI done to each of those currency pairs from a technical level in regard to bias and in regard to risk and in regard to targets? So let's get started. Starting off by looking at the dollar versus Canada, I'm going to look at the hourly chart first. And if we take a look at this surge to the upside here, we were trading below this cluster of moving averages here and also below the 200-day moving average right through here. But the CPI data sent that price surging to the upside, and in the process, we moved above this swing area right through here. It's outlined by this yellow area through here, and you can see the number of different times that the price came up to test that area, including in trading last week where we had three different times with price testing the high of that swing area near the 135.43. The swing area comes between 135.26 and 135.43, and you can see the price has surged above that level. We're also above the 100-day moving average. That comes in at 1.3556. And that level is now going to be our close risk level for the pair. We're currently trading at 135.65, so we are rotating back down toward that level. Traders who are looking for the buying to continue in the US dollar could use that 100-day moving average as support, but also may use a more conservative 135.43 level as a risk-defining level. You can see all the different highs right here. The price should not start to head back into that yellow area if the buyers are taking more control. So keep those levels in mind. Take a look at the daily chart for this pair. As far as targets go, this is where we sit right here. This is the highest level going back to December 14th, so mid-December. So it's not exactly we've seen these levels just a few months ago for this currency pair. The high prices in the month of December come in right around the 136.22 level, and that would be the next target on the top side. Above that, maybe look toward the 136.63 level. If I put a Fibonacci retracement from this high to this low right here, the 50%, or we're above the 50% retracement, the 61.8 comes in right around that this high right here near the 21 level. So 136.19, that increases that level's importance as a target on the top side for the dollar versus Canada. Let's take a look at the Aussie versus US dollar. Next, I'm going to look at the 4-hour chart for this currency pair, and you can see that just prior to the report, the high price was testing the 100-day moving average. That's a blue line in this chart. Remember, we talked about this key swing area. The swing area goes all the way back to these levels right through here. Nice little floor. We traded above and below the level, but use that level through here. And in trading, again, this is the 4-hour chart. In trading this week, we traded above and below it over the first couple of days before the data came out and sent the Aussie versus US dollar sharply to the downside. So moved away from that this risk level, and in the process tilted the bias obviously more to the downside. We are testing this swing area through here where we had a number of different swing highs through here before breaking to the upside. We fell back below that level and used the level again as resistance before moving to the downside, and then on the way back up we sort of based against this level and then based right here before moving to the upside. So back to that swing area here that took place between October and November. That area comes between 164.44 and 45 and 164.55. Get below that level opens the door for further downside momentum in this pair, so be aware of that. Holding the level, watch this level right here. That was a low price from last week's trading, 164.68. We've been above and below that level, but if we start to trade more comfortably above the 0.6468 level, that might tilt the bias, give the shorts a reason to cover and push the price a little bit more to the upside. But certainly the downside is the favored direction for this pair. Finally, let's take a look at the New Zealand versus US dollar. This currency pair moved sharply higher at the end of last week, right through here, on the back of ANZ's report that they expected 2 more hikes in New Zealand. Now we're taking away some hikes or some cuts in the U.S., and that's sending the New Zealand versus U.S. dollar sharply to the downside. We are back below the 200-day moving average and the 100-day moving average. That's the green and blue lines in this chart. The 200-day moving average comes in at 0.6081. The 100-day moving average is just above the 50% retracement of this move up from this low to this high right here. That level 50% comes in at 0.6070. So that area between 70 and 81 is now resistance for sellers. Stay below that level keeps the sellers more in control. On the downside, the low price from last week's trading came in right around the 0.6036 level, and that would be the next target on the downside. If we break below that level, look toward the 60 level, which happens to be the 61.8% retracement. That level comes right here at 0.600, nice round number. Increasing that level's importance from a technical perspective, a natural technical perspective. So there you have it. A look at the three of the commodity currency pairs after the stronger than expected US CPI data. My name is Greg Michalowski. Good fortune with your trading. Bye-bye now.